Hey, we're live from Pearland, Texas. This is What's Up with Real Estate, the show that, turns this week's headlines into a plan, not a pitch. Hey, whether you're buying, selling, refinancing, already own a home, or simply wondering whether this is the right time to make a move, well, this conversation is just for you. This week, the market is, being pulled in multiple directions. Hey, a weak jobs market, a relatively tame inflation report would normally argue for lower interest rate. But hey, oil prices are climbing again in tension with Iran, and the national debt has now cost $40 trillion. So mortgage rates barely moved. We will explain why, clear up a major misunderstanding about inflation, examine a cruel summer of home sales, and identify 3 moves that can, disrupt your mortgage loan approval. So stay with us, because the headline may sound contradictory, but your plan does not have to be. So, talking point number 1, mortgage rates. They're, steady. But before we examine mortgage rates, let's introduce our illustrious AI, artificial intelligence, AI co-host, our economic analyst, occasional philosopher, and aspiring comedian, ChatGPT Soul. So, introduce yourself.
Hey everyone, I'm Sol. I'm here to help make this stuff clearer, calmer, and maybe even a little fun. I'll keep it tight, one insight at a time, and try to earn my airtime.
Yeah, so Freddie Mac, not MortgageMack, but Freddie Mac reported that the average 30-year fixed mortgage rate was 6.65 this past week. As of August the 20th, that is down only 2 basis points from 6.67 that we discussed last week. So the fair description is steady. 1 year ago, the average was 6.58%, and February's recent low was 5.98. Now, the interesting question is not where rates landed, it is why didn't they fall? And July payrolls declined by 23,000. We talked about it last week. May and June jobs were revised downward by a combined 103,000 jobs. Consumer prices rose just 0.1% in July, and both headlines and core inflation slowed year over year. And under normal circumstances, we think that we would have an improvement in interest rate. But the combination of weak hiring and softer inflation would put downward pressure on bond yields and rates. But hey, the bond market does not react to one report in isolation. Oil prices are rising because of the war with Iran. And has disrupted shipping through the Strait of Hormuz, and higher energy costs threaten to reignite inflation just as it appears to be cooling. And hey, something called the federal debt has now just crossed $40 trillion, a problem built over decades, but worsened by current policy of tax cuts weighted towards higher income households, widened the deficit, projected tariff revenue that fell short, and the Treasury must borrow more and more and more. And hey, I heard they were robbing Peter to pay Paul this past week, and that borrowing pressure has kept bond yields and mortgage rates higher. So how can the economic data say lower rates while mortgage rates stand still?
Because the bond market prices the road ahead, not just the last mile.
Weak jobs and cooler inflation help, but rising oil and heavy government borrowing make investors cautious. If you are considering a purchase or refinance, build around a payment that works for you today. Compare rates, points, seller credits, and lock-in options. If the market improves, we can adjust the plan, because we'll have a plan, not a pitch. And hey, economists say inflation is cooling. The grocery aisle would beg to differ and request an apology. And that brings us to the word cool. Talking point number 2, understanding the inflation and the term cooling with respect to the most recent inflation data that came out. When you hear that inflation fell, it usually does not mean prices fell. It means prices are still rising, but the pace of the increase has slowed. This is disinflation. Deflation means overall price levels actually are falling, and sustained deflation is often associated with serious economic weakness. Think of a car slowing from 50 or 65 to 55. It is moving more slowly, but it's still moving forward. A slower or a lower inflation rate means prices are generally rising slowly, but not reversing. In July, headline CPI rose 3.4% from a year earlier, down from 3.5% in June. Core CPI, which removes food and energy, still rose at 2.5%, down from 2.6% from the previous month. Progress, but it does not erase earlier price increases. The Federal Reserve, Sol?
Yeah, the Fed focuses on the trend, not 1 month. The goal is stable inflation, not prices rolling back.
Yeah, the goal is 2% measured by its preferred PCE index. So tell us what PCE means.
PCE is personal consumption expenditures. It captures how people actually spend, and it updates with changing habits. That's why the Fed leans on it.
Yeah, so don't build a housing budget around the hope that prices will fall. You use verified income, and if you need some assistance with how to quantify that, let me know. Use real current debt. Pull a real credit report from freecreditreport.com. And connect with me if you have a home in mind. We'll help you determine the real taxes, the real insurance, maintenance cost, and to give you and your family enough breathing room to sleep at night when faced with a new mortgage payment. So let's take a quick break and a pause from this week's sponsor, HOAshare, and stay with us because we are going to talk about the cruel summer that we experience in housing sales.
Tired of home service hassles? Introducing HOAshare, your trusted partner for local services. The only HOA platform that pays you back. Earn cash back on every service tracked in real time. Easily manage payments, all in one place. From plumbing to home cleaning and more, HOAshare connects you to trusted service providers. Connect, buy and sell, get notified, and more. HOAshare. Your HOA finally worth something.
Hey, thank you, HOAshare. And talking point number 3, well, it was a cruel summer. The National Association of Realtors reported that pending home sales fell 2.3% in July from June and 2.2% from 1 year ago. That was the lowest level since January. And, this is generally the busy season. Here in the South, pending sales fell 2.2% for the month and 3% from a year earlier. NAR chief economist Lawrence Yun summed it up this way. The highest mortgage rates of the year hit right in the middle of summer, and that's pulling back contract signings. I would agree with that. He also pointed to record high prices, longer marketing times, fewer buyers, bidding above asking, while emphasizing that local markets vary widely. A national headline cannot describe your street, price range, or Pearland or Greater Houston neighborhood. And for sellers, this is not the market for testing an ambitious price and hoping buyers surrender. Price presentation, condition, and access must work from day one. Buyers, slower activity, create room to negotiate repairs, closing costs, seller-funded rate buy downs, and not every seller is desperate, but you may have more time to inspect, compare, and negotiate. And the practical takeaway is not buy now or wait. It is to learn who holds the stronger hand in the specific transaction in front of you and negotiate accordingly. Be prepared to win. And we believe our MortgageMack offer strategy is the best option in the marketplace to help you win the offer and win negotiations during the option period. Okay, so we'll bring you back in here. And hey, this is your segment. And give us the market confidence check. Green light, red light, or something in between. So,
Yellow light. Demand hasn't disappeared, but many are waiting on affordability. If the numbers work for you now, move carefully. If not, don't force it.
Yeah, that is exactly right. Opportunity and affordability, well, they are not the same thing. We want both the house and the monthly payment to make sense. And the best way to do that is to get with yours truly. We'll help you make a mortgage plan instead of a mortgage pitch. All right, for this week's mortgage and money strategy. Once you begin the home buying process, financial stability becomes a part of your approval. 3 moves. can cause some serious trouble. Transferring large sums without documentation, applying for new credit, and changing jobs without speaking to yours truly first. And I had both those instances just last month. A lender may verify your credit, assets, income, and employment again before closing. We are definitely going to do that. There is no may. A sudden change can alter your debt to income ratio, delay closing, or make the loan ineligible. The same is true too when you apply. We only do a soft credit report. So it's really important in that interim time frame from the soft to the hard pull when you get your contract. You gotta keep your payments up. Don't apply for new credit. All of that can negatively impact your credit report and negatively impact your transaction once you have a contract. So you don't have to stop living. Just communicate before a major move. Do not finance furniture before you own the floor beneath it, and call your lender before changing jobs. Not from the parking lot after the farewell cake from your previous employer. Smooth sailing to closing day usually comes down to one simple rule. Call me first, please. If you are unsure, call me, please. A 5-minute conversation can prevent a 5-day emergency. And well, mortgage discipline is really stoicism with bank statements. Control what you can, communicate clearly, and do not let an impulsive trip to the furniture store or the appliance store to disturb your. Okay, this week's Stoic wisdom comes from Marcus Aurelius. And say to yourself early in the morning, I shall meet today's ungrateful, violent, treacherous, envious, uncharitable men. All of these things have come upon them through ignorance or real good and ill. I can neither be harmed by any of them, for no man will involve me in wrong, nor can I be angry with my kinsman or hate him. For we have come into this world to work together. And man, that is just a really key element that I believe we are missing in society. And the lesson is not that difficult people become easy. It is that their behavior does not have to choose yours or mine. Stay grounded in facts. Act patiently. Focus on what you can control. Calmness is not passivity. It is leverage. And Marcus Aurelius believed we came into the world to work together. Underwriting believes they came into this world to ask for more bank statements.
Words don't lack kindness. They lack context.
Are you ready for puns?
They read paper, not people.
Yeah.
Give them a clear story and the file starts to breathe.
That's exactly right. And you know, you really nailed it there. So is a clear story and that substantiates exactly or clearly communicates what the objective is. And I had a person that loan was approved this week, and his loan had been denied by everyone. And what we changed was we created a different narrative in the way that we presented it, solely because underwriters have a certain expectation with regards to certain levels of income, and we didn't have the assets to support that income. But what we did have is we have a business model, and we made clear our business model was conducive to the dividends and interest income, conducive to the capital gains, because he's in real estate, but he doesn't work with buyers and sellers in general. Buys homes at the auction, and he flips them or he owner finances them. So what we did is we just created a different narrative, provided the documentation, and we got a yes. So are you ready for puns?
Hit me.
Let's begin with Fizbo.
For sale, barely organized. Side effects may include surprise paperwork.
Yep. Not every owner selling a loan, but enough of them to keep the printer running. How about DTI? So give us some clarity around that.
Debt that's inescapable. Don't worry, it's escapable. With math, let's consider a plan.
Why don't you tell everybody what mortgage really means?
Traditionally, it comes from words meaning death pledge. But today, think of it as a monthly promise, not a life sentence.
Yeah. 30-year sentence. And HOA?
Holy overreach. Again. Kidding, sort of. Read the rules before you sign.
Yeah, that was submitted with architectural approval and still came back denied, and give us the alternate definition of FISBO.
Financially stubborn, badly overpriced.
You're going to get us uninvited to any open houses. Let's finish this out with everyone's favorite mortgage term, mortgage acronym, APR.
Actual pain revealed. But seriously, annual percentage rate, the all-in cost lens that keeps comparisons honest.
Yeah, so hey, if any of those definitions left the bruise, remember the real cure is good advice, better paperwork. Hey, thanks for joining us for this week's episode of What's Up with Real Estate. A big thank you to our sponsors, List Reports, Rate, and HOAshare. If you found value in today's discussion, please subscribe, follow, and share this episode with someone who could benefit from staying informed, benefit from an objective view and approach to the mortgage process. And if you want to plan that pitch, you can always book time with yours truly at #MortgageMack and find my Google My Business page. And remember, knowledge is the key to making the best decisions for you and your clients. Join us here every Saturday, 10 a.m., live from Pearland, Texas, right here on LinkedIn and Facebook. Until next time, stay informed, stay engaged, and I'll see you at closing.
See you next week. Steady and clear-eyed.
Yeah, I think so.
Late night. Late night, it's early mornings, he stays on the grind. Looking past the rate sheet for the value you'll find. Every signature means more than the dollar you just said.